Once upon a time on Wall Street, there was a name that echoed with power and prestige: Lehman Brothers. For over 150 years, this financial titan seemed invincible. It all started back in 1844 when Henry Lehman, a German immigrant, opened a small dry goods store in Alabama. His brothers, Emmanuel and Meyer, soon joined him, and they quickly pivoted from cotton trading to the booming world of finance. They survived the Civil War, the Great Depression, and 2 world wars, each time emerging stronger. By the early 2000s, Lehman was the 4th largest investment bank in the United States, a global powerhouse with its name etched onto skyscrapers and its influence felt in every corner of the market. They were the giants of Wall Street, the masters of the universe. Their story was the American dream written in stock tickers and billion-dollar deals. But every titan has a weakness, and Lehman's was an insatiable appetite for risk. In the early 2000s, a new gold rush was on, the U.S. housing market. Prices were soaring, and it seemed like a bet you couldn't lose. Wall Street wizards cooked up something called mortgage-backed securities, or MBS. Here's the simple version. Banks would bundle thousands of individual home loans, good, bad, and ugly, into a single package and sell slices of it to investors. Lehman Brothers didn't just dip its toes in this water, it dove in headfirst. It became one of the biggest players in the game, buying up mortgage lenders and underwriting billions in these complex securities. The problem was, many of these were subprime mortgages given to borrowers with poor credit who were more likely to default. But hey, housing prices only go up, right? So the risk seemed minimal. Driven by the lure of massive profits, Lehman loaded up its balance sheet with these risky assets, leveraging itself to the hilt. It was a high-stakes gamble, a financial house of cards built on the assumption that the party would never end. But the party did end. By 2007, the music stopped. Homeowners started defaulting on their subprime loans in droves. Foreclosure signs popped up like weeds. Suddenly, those safe mortgage-backed securities were revealed to be toxic junk. Their value plummeted, and the foundation of Lehman's empire began to crack. Panic set in. Throughout 2008, the bank's stock price went into a freefall as investors realized the sheer scale of its bad bets. CEO Dick Fuld desperately scrambled to find a buyer, a savior, anyone to stop the bleeding. He held frantic talks with banks in Korea, China, and the Middle East. He pleaded with rivals like Bank of America and Barclays. At the same time, the U.S. government, led by Treasury Secretary Hank Paulson, was working behind the scenes, trying to broker a private sector rescue. Earlier that year, they had bailed out another struggling bank, Bear Stearns. Everyone assumed they would do the same for Lehman. It was just too big to fail, so they thought. The weekend of September 12, 2008 was the moment of truth. The heads of Wall Street's biggest banks were summoned to the New York Federal Reserve for an emergency meeting. The government made its position clear. There would be no public money, no taxpayer bailout for Lehman. If a deal was to be made, it had to be funded by Wall Street itself. The last hope was Barclays, a British bank. But at the 11th hour, British regulators refused to approve the deal without a guarantee from the U.S. government, a guarantee that never came. The talks collapsed. On Sunday, September 14th, the news broke. It was over. The next morning, Monday, September 15th, 2008, Lehman Brothers, a 158-year-old institution, filed for the largest bankruptcy in U.S. history. Employees were seen leaving their global headquarters, carrying their belongings in cardboard boxes, their faces a mixture of shock, anger, and disbelief. The titan had fallen. The unthinkable had happened. The collapse of Lehman Brothers wasn't just a tremor. It was a magnitude 9 earthquake that sent shockwaves across the entire global financial system. The day it filed for bankruptcy, the Dow Jones Industrial Average plunged 500 points, its biggest one-day drop since the 9/11 attacks. But that was just the beginning. Lehman was so deeply intertwined with other banks, hedge funds, and corporations around the world that its failure triggered a domino effect. A crucial money market fund broke the buck, meaning its value fell below $1 per share. It's causing widespread panic among everyday investors who thought these funds were as safe as cash. Credit markets froze solid. Banks stopped lending to each other, and then they stopped lending to businesses and individuals. The gears of the global economy ground to a halt. Suddenly, the crisis wasn't just a Wall Street problem. It was an every street problem. It led to mass layoffs, shuttered businesses, and a deep, painful recession that affected millions of lives worldwide. The fall of one bank had pushed the entire world to the brink of financial Armageddon. In the smoldering ruins of the crisis, the world asked, how did this happen, and how do we stop it from happening again? The immediate aftermath brought a flurry of new regulations. In the U.S., the Dodd-Frank Act was passed, a sweeping piece of legislation designed to rein in Wall Street. It created new oversight bodies, required banks to hold more capital as a cushion against losses, and introduced the Volcker Rule, which aimed to limit risky speculative trading by banks. The idea of too big to fail was directly addressed with mechanisms for winding down large, failing financial firms in an orderly way, hopefully avoiding another Lehman-style panic. Globally, regulators coordinated to implement similar rules, known as Basel III, to strengthen the banking system. These were the lessons learned, written into law. But have they been heeded? In the years since, there's been a constant push and pull. Some argue the regulations have made the system safer, while others claim they stifle growth and have been watered down by intense lobbying. The financial world is ever-evolving, with new products and new risks emerging all the time. The memory of 2008 is a powerful warning, but memory can fade. The story of Lehman Brothers serves as a stark reminder that in the world of high finance, pride, greed, and a disregard for risk can lead not just to the fall of a titan, but to a tragedy for all. Thank you for watching. If you found this story insightful, please like, share, and subscribe for more deep dives into the events that shaped our world.